Okay, welcome back. Hal antum jahizun? Falnabda. Okay, let us continue. Let us compare between this inventory system, application of the alternative cost flow assumption that we have shown before in the previous video, yeah, result in different value of your closing stock. Okay. So the value obtained with the specific identification method are the same, but because the unit identified as sold are the same under the both inventory system, when we use the LIFO method, both ending inventory and cost of sale dollar amount may vary between perpetual and periodic system. So that is the challenge, yeah. So apart from that, we also have this concept of lower of cost and net realizable value. Under IAS number 2 or ASB 102, it requires that inventory to be valued at the lower of cost and net realizable value. So you need to compare the value of your cost, what is the cost, and what is the value of the inventory if you sell the item. In certain instances, you can see that the value, that the net realizable value is much lower compared to the cost. For example, you have all this old stock where you purchase at a very high price, you're not able to sell that item. Now the value has dropped. For example, if you have this phone, you have this phone. This is the old phone. It might cost maybe 1,500 dirham 4 years ago, and then because you are not able to sell the items, now the value is only 500 dirham. So you have two value there. Are you going to record 1,005 or the net realizable value of 500 dirham? So the answer is we go for the lower of cost and net realizable value. You cannot put in your balance sheet the value is 1,500 because that is overstated of your inventory value. So you should record it as 500 dirham only. So the standard defines net realizable value as the estimated selling price in the normal cost of business less the estimated cost of completion and the estimated cost necessary to make the sale. Whatever transaction cost, if you have to pay the commissions, the agent fee, or maybe if you sell using Amazon, they charge you certain fee, so that have to be deducted from the sales price. Second, current replacement cost is defined as the cost that the not-for-profit entity would incur to acquire the asset at the end of the reporting period. If you are running a maybe charitable body, yeah, so you don't sell the inventory, so you need to take what is the cost to replace the item. If you want to buy the same item, what will be the cost? So you compare the cost of net realizable value and your cost calculated using either FIFO, weighted average, LIFO, and then see whether whether which one is lower, which one is lower. So that is the formula: lower of cost and then realizable value. You need to compare the cost of inventory that you determine using FIFO, LIFO, or weighted average and compare with the net realizable value. If your net realizable value is higher than the cost, you're going to record the cost value. But if the net realizable value is lower than the cost, you're using the net realizable value as your inventory values. How about return? How about return? Sales return. Return using first in and first out method. Purchase return are shown on the inventory record at the negotiated price. Yeah. However, for sales return, they are costed back into inventory at the most recent cost price that had been attached to the sale. At what price we attach the inventory to the sales? Good return are brought in at the latest price attached to the relevant sales to ensure that the cost of sale still reflect the first cost out of inventory. So this is about the sales return and purchase return. Returns, will cost the inventory account after sales return to reflect later cost incurred and will ensure consistency with FIFO calculation under the periodic inventory system. You are going to do few example with Miss Yusra on this. Okay. If you use return using the moving average method, so under the moving average method, a new average cost per unit is calculated after each purchase and also after each purchase return. Every time you do purchase, every time there is a purchase return, you need to calculate the new average, the new average cost per unit. Yeah. So the purchase return is recorded on the inventory record at the actual price negotiated. What is the previous price negotiated with the supplier and not the moving average price. So that is for the moving average method. And then sometimes we have this error. So the inventory balance of unsold good is often the largest current asset reported in the balance sheet. We have all the PPE, but we also have the inventory. Sometimes the inventory is greater than your cash. So if a perpetual inventory system is maintained, a physical stock take is made at the end of the period to check whether the balance in your record is equal or identical with the physical existence of your inventory. So you need to check. Normally what accountants do is they will print the inventory list, the blank inventory list without quantity, and then they will pass it to a group of employees or maybe third party sometime, and then ask them to go and count the quantity of the item. So from there, they don't have any idea what is the correct number, but they just go there and count the amount of inventories, the quantity of the items, and then they will compare the difference. Right? Is there any difference between the record and the physical and the physical number quantity? So that is how we do the stock take. Under the periodic inventory system, errors may occur in counting and pricing the inventory and in the failure to use the proper cut-off date for recording purchase and sales. This is very common problem in business because, for example, if even though you close your account on 31st December, sometimes there is also stock remain in your warehouse that belong to the customer. So that cause differences, incorrect quantity of inventory recorded when you do your stock take. So be careful on that. Another thing is estimating inventory. When a perpetual inventory accounting system is used, the cost of sales and the dollar amount of the inventory on hand are readily determinable throughout the period from the accounting record. So if you use periodic inventory system, the preparation of the income statement require that the inventory on hand to be determined. If you use periodic inventory system, you don't know the balance of your inventory, like what we have in our perpetual inventory system. So every time you want to prepare your financial statement, you have to determine your inventory. You have to perform the stock take, so it gives you your inventory, and you are going to use that inventory value to determine your cost of sale. How is the formula to calculate the cost of sale? Opening stock plus purchases. If you have a return, you minus return, and then you minus your closing stock, closing inventory. Yeah, opening inventory. This is your opening inventories minus your closing inventories. So from here, you will get your cost of sale, Otherwise, you won't be able to determine your gross profit because you don't know what is your cost of sales. So the retail inventory methods and the gross profit method are two approaches that can be used to estimate the dollar amount of unsold goods without a stock take. So this is another technique here. There is the retail inventory method. Another one is the gross profit method. So this is how we can use this method to estimate the amount of unsold inventory. Okay. So under retail inventory method, yeah, we have two ways. In one approach, no physical stock take is performed and the cost of inventory is estimated. You just estimate the cost of inventory. The second one, physical stock take is carried out and valued at the retail price, and this value is then converted to cost for, for financial statement purposes. Number one, with without estimating the ending inventory. Number two, by doing a physical stock take. Under gross method, this profit is based on assumption that the gross profit percentage remain approximately the same from one period to another period. For example, from your sales, you have these sales, your gross profit normally is 40% of sales. 40% of sales. Yeah, from your sales. 40% on sales. Yeah. So if your sales for current year is 100,000, so you can estimate that your gross profit should be 40,000. Your cost of sale should be 60,000. So this is estimating using gross profit method. Okay. If an estimated value for ending inventory for the current period is required, then gross profit percentage of the previous period is used. We use the previous year gross profit percentage. So how you're going to present this inventory in your accounts? Normally for retail business, we only have one type of inventory, that is inventory held for resale. But for manufacturer, if you are a factory, you have a factory, so you have many types of inventory. The inventory can be raw material, not used yet. Yeah, we have inventory that is classified under work in progress, not ready for sale, but it's not raw material. And finally is the finished good. I'll give you a simple example because we are in festive season now. Many of our friends will celebrate Diwali this Thursday, this coming Thursday. So I believe they are making a lot of cookies. Yeah, maybe cakes, yeah, cakes. Yeah. So for cake, for example, what are the raw material? They have flour, butter, sugar, milk. Yeah, all these are the maybe vanilla essence. I'm not sure. I never bake any cake. So these are the raw materials. Okay, one type of inventory. The second one is maybe the dough. I'm not sure whether everything that has been mixed, they have put it in the mixer, maybe they have put in the oven, but it's not ready yet. That is work in progress. And finally, is the cakes that have been have yeah, ready for sales. Yeah, you have packed the cake, wrapped the cake, and ready to be sold to your customer. So these are three types of inventory, and you need to classify this into raw material, finished good, and work in progress. What are the effect of costing method on decision making process? In time of rising prices, inflation, the FIFO method produced the highest gross profit. Why? Under FIFO method, the cost of sale will be lower. The cost of sale will be lower, so the gross profit will be higher. The LIFO method, on the other hand, will produce the lowest gross profit ratio and the highest inventory turnover. What is it? If you use the LIFO method, your closing stock will be lower. That result in high cost of sale. High cost of sale. So that is why your gross profit will be lower. So the moving average method lies between FIFO and LIFO. So moving average is in between. That. So as for the specific identification method, the three ratios can be manipulated merely by careful selection of the specific item to be sold. Because of this, I can see certain countries they already restricted the use of LIFO method. Maybe they have some, maybe you can use specific items method or moving average or FIFO methods. As a summary, how an entity determines its inventory on hand by way of physical stock take or how the cost of inventory is determined is very critical. So we have discussed few methods of that. So cost of sale and the alternative cost flow assumption for the periodic inventory system vary between these three methods. The valuation for ending inventory, the cost of sale also vary. Okay. The result for cost flow assumption for the periodic and perpetual inventory system, and also about the formula, the lower of cost and net realizable value have been applied by accounting standard where you need to choose between these two value, the lower value, whether either the cost value or net realizable value, and how to account for sale return and purchase return, and how we should adjust the errors in determining inventories, as well as the value for inventories in retail inventories and gross profit. So these are the things that we have covered. And finally, the important to disclose information on three types of inventories in the financial statement, as well as the effect on the profitability and also inventory turnover. So that are the things that we have covered under this topic, and more exercises will be done during your tutorial.